So friends, welcome to this class and let's learn about candlestick patterns in this video. So today I'm going to explain you the basics of the candlestick patterns. We'll also discuss about the psychology behind the patterns, and finally we will learn how to trade these candlesticks. And if you stick to the last of this video, you will get a lot of tips and tricks about trading candlestick patterns that you will never find in any of the books. So as most of you must be knowing about the candlesticks, it represents the snapshot of price for a particular duration. In this candlestick pattern, you will notice four important things. The first one is the open and the close of the price, and the high and the low, which is called as the wicks or the shadows, the tails. If the open is less than the close, then you will see the red candle. If the open is greater than the close, you will see the green candle. So that's what basically a candlestick represents. It's a basic snapshot of the price and what happened in the duration, mainly who were in charge, is it the bulls or the bears during that particular time duration. So here you notice that few of the commonly traded candlestick patterns that occurs very frequently in the market. So before understanding the candlestick, we need to clearly understand the psychology or the activity that happens when a particular candlestick is formed in the chart. So let's begin with the hammer pattern. You see here, it is called as the hammer pattern. Okay, it looks like a hammer. So what happens here is, let's say the price opens at 100 rupees. So the bears try to push the price lower. Okay, so the price goes to, let's say, 95, but the bulls are in charge as soon as the price hits 95, and they completely take the price to 105. Okay, so the price opened at 100, it closed at 105. The market came lower, but the buyers got so aggressive that the price again jumped higher. Okay, so here you see a green candle forming which looks like a hammer, and this mainly happens at the end of a downtrend. Okay, so this pattern strongly signifies that the bears are slowly losing control of the downtrend. So once you notice this pattern in the real market, you need to wait for a follow through candle, okay, to get more clarity about whether the downtrend has finished. Is the market ready for a up move, or is the market ready for a consolidation? So the exact reverse of the hammer pattern is the shooting star. Okay, this is a bearish pattern. So what happens here is that the price opens at 100 rupees. The bulls try to push the price higher and take it to 105, but the bears come very strongly and take the price to 95. Okay, so the close is less than the open price. So that's why you're seeing a red candle. It can be a small minor green candle as well, but the main thing to notice here is that it happens at the top of a uptrend and near a resistance, near a major resistance. So if it happens, you can be fairly sure that the uptrend is losing steam, the bears are taking control, and the market can reverse anytime soon, or it will go into a consolidation phase. So you need to book all your long positions once you find this pattern. So now we'll cover these two in the charts. Okay, so let's go to the chart of Bank Nifty. Okay, so I have opened the 15-minute charts of Bank Nifty. So now we'll try to find the pattern hammer and shooting star. Okay, tell me in the comment section where you are able to see the hammer pattern and also the shooting star pattern. Just take a guess. So now say this is a perfect hammer pattern that is occurring. Okay, you see the market was in a downtrend. Okay, it came from 36,200 till 35,750 or something like that. So now you will see this is not exactly a bullish hammer, but yeah, this one also can be taken as a hammer because it happens at the fag end of the downtrend. Okay, now the market goes into consolidation phase, and once you see this candlestick pattern at 1 o'clock, which is a clear hammer and it's a bullish hammer. Okay, after that you see that the market starts rising consistently. Okay, so this candle signifies that the bulls have taken charge and the downtrend is finished. Okay, so similarly we'll see more patterns. Again another hammer. Okay, there's a strong downtrend here, like right from the beginning. Then you see a strong hammer pattern coming, and then the follow-up candle is also good. Okay, so basically the follow-up candle shouldn't cross the low of this hammer, and you see that the market starts rising after that. Okay, so now we will see one shooting star. Okay, so now you can see the market is in a strong uptrend. Okay, it's consolidating, and now you see a shooting star pattern here. Okay, at 1 p.m. exactly. So this says that the uptrend is about to finish. So in the follow-up candle you see that it's a doji, which pattern will discuss further. And now you see that the lowest point of the shooting star is broken in this candle. So here in this candle you can easily short and get 1:1 risk reward. See, this is a perfect hammer actually. Again, so you see the market is consistently trying, the bear side consistently trying to push the market lower, but you see a hammer pattern with a good amount of volume as compared to the previous volume. Okay, so you need to see that volume is a very important criteria while judging the candlestick patterns. If the candlestick pattern is formed with good amount of volume, then it signifies the strength of that candlestick pattern. See, perfect shooting star example. Okay, so the market was rising since the morning, and then this shooting star happens. The volume is also good as compared to the previous candles. Okay, so immediately after the next candle it breaks the low of the shooting star, where you can short and you will easily get 2:1 risk reward. So one thing to note is that if you find a hammer pattern at when the RSI is less than 30, or let's say if you find the shooting star pattern when the RSI is more than 60 70, that becomes a very high probable trade if the volume is also there. So now let's see the previous examples that we have taken. See, here you see that the market is strong downtrend. The RSI is showing 18.79. It's 18.79, so which means it's in the oversold region, and then this hammer pattern forms. The volume is also good. Okay, and after that you still need to wait. There is a follow-up candle as well. Okay, the follow-up candle is green again, so this signifies that the bulls are taking charge. Okay, and you will easily get a 1:1 trade from here till here. Your stop loss should be the low of this candle. See the shooting star actually. The candle volume is also really high, 426.3k. Okay, you see the volume here. The follow through candle is not very convincing because it doesn't breach the low of the shooting star candle. So like the trade that you can take here at this point with 1:2 risk reward, you can easily get it here. So the market falls like 1:4 risk reward also probably you will get in this trade. Okay, so now here again hammer pattern, you will see the market is consistently falling. Okay, now it forms a strong hammer pattern with the RSI at 39.71. the volume is also good. The follow-up candle is also good because it's trying to go higher. So you can take a trade with keeping the stop loss below of this hammer candle. Okay, so if you take the trade here, let's say at 16,220 going long, the low should your stop loss should be 16,179. Okay, and your risk reward should be 1:1 or 1:2. See, this is again a perfect shooting star where the market is consistently going up, and you see a shooting star. Okay, and after that you need to wait for the follow through candle. It should close less than shooting star candle. So here also you will see one shooting star candle. Okay, it's in a uptrend, you will see a shooting star. The volume is also good. So now you need to wait in the next candle. So the next candle is closing higher than this candle. Okay, so this doesn't give a very good entry point. Okay, so you need to wait further. So now the market tries to go up again, another shooting star, and here you see that the follow through candle is good. The volume is also increasing actually. Okay, so this is what the confirmation sign that you need to wait to enter into a trade. So just note few things. The candlestick pattern is the first thing to look for. The second one is where it occurs. That's a very critical piece of the whole puzzle. The third is, so you need to also see the volume. So the volume need to be higher as compared to the previous two candlesticks. Next important fact is the follow through candle should need to happen. Okay, it's a very important thing. You cannot take trades just based on the candlestick patterns. The follow through has to be there. Okay, so if you are seeing a hammer, the follow through candle should close above the close point of the hammer. If you are seeing a shooting star, the follow through candle should close lower than the closing price of the shooting star. Okay, and added to that, you also need to see the basic indicator RSI or stochastic, or let's say MACD, so as per your convenience, and the indicator also needs to see the same thing. Okay, so if it's a shooting star, the indicator should say that the market is currently in the overbought region. If it's a hammer that you're looking for, the indicator should also say that the market is currently in the oversold region. So if you combine all these things, it becomes a very high probability trade. So now we will move to the next set of candlesticks. This is called inverted hammer. Okay, so it is primarily the shooting star pattern, same, but since this occurs at the end of a downtrend, it's a bullish pattern. Let's understand the psychology here. The price opens as 100 rupees, let's say. The bulls try to take it higher. Let's say it goes to the 105, and then the bears push it back to 103. So what happens is that the price closes higher than its opening price, so it's still a bullish sign. Similarly, if the exact reverse of this is the hanging man pattern, which happens at the top of a uptrend, what happens here is that, let's say the price opens as 100 rupees, bulls try to take it higher, but the bears push it down. Let's say the price goes to 95, then the bulls fight back and close the candle at 98. Okay, so the opening price is higher and the closing price is lower here. So this signifies that the uptrend is about to finish, or let's say lose its steam. Okay, so similarly the next set of patterns is dragonfly doji or gravestone doji. So dojis are the kind of patterns where the open and the close is basically the same, or very close to each other. Okay, so since you have a very long tail that you can see towards the down, you can assume that it's a bullish pattern. Okay, so always remember one thing: if you see a long tail towards the down and it happens at the end of a downtrend, it's a bullish pattern. Okay, so similarly the exact opposite, if you see a long tail towards the up and it happens at the highest point of an uptrend, it's a bearish sign. So the dojis and the hammers are basically same. The only difference is, in the hammer the closing price is more or less from the opening price, but here in doji it's almost similar. So the next pattern that we'll discuss is bullish engulfing. What happens here is that you get a complete reversal of the market. If it happens at the end of the downtrend, it signifies that the trend is about to reverse. So similarly, exactly the same thing in the bearish side. Market is in a strong uptrend, you will see. So now you see a complete reversal candle, which is the bearish. It covers the whole body of the previous candle. Okay, so now this establishes that the bears have taken control. So let's look at these examples in the chart. Example, see, this is a perfect example of a bearish engulfing. Okay, you see the market was in a constant uptrend. Okay, it's going up, and it's a big bullish candle also formed, but you see that the next candle is a very big bearish candle that covers the whole body of the previous candle, and after that you see that the market starts coming down. Okay, so for a big engulfing candle, whenever you see either bullish or a bearish, if you want to take a short position on a bearish engulfing, try to short at the half of this candle, not immediately after this bearish engulfing candle. Always wait for a reversal, and the market should come to the half of this engulfing candle, and then it becomes a very good risk reward trade and a high probability trade to take a short position at half of this candle. So you see here exactly the market falls right from the half of this candle, it goes up to this way. Okay, see, this is a bullish engulfing pattern again. The market was constantly coming down, and you see that a strong green candle forms that covers the whole body of the previous candle. Okay, and if you want to take a long position, take from half of this candle. From here you need to take the entry of the long position, and your stop loss should be less than less than the lowest point of this engulfing candle, which is here. Okay, and you easily get a 1:1 risk reward trade here. Okay, so here again another engulfing candle. You can see we see a strong bullish engulfing. If we wait for the market to come to the half, probably we don't get any trade here, but it's fine. We should always wait for the highest risk reward trades here. This is a engulfing candle actually. Okay, bullish engulfing. Here you can see that this is a dragonfly doji. Okay, the open and the close are almost similar, but you see a very long wick. One thing you need to understand that the candlestick patterns don't work all the time in the market. Your role as a trader is to take high risk reward trades. So when the market doesn't follow the candlestick patterns, you exit with your defined stop loss. Yeah, remember one more thing, when the market opens, so you should wait for the first 3 candles at least, let the market settle down. Okay, so now let's discuss the further 2 patterns. So these 2 are neutral patterns. They generally occur when at the top of a uptrend or at the lowest point of a downtrend. So these 2 candlestick patterns, like the doji, where there's equal wick on the top and also on the bottom, and the open is exactly same or very near to the closing price, and the spinning top is also again the same thing. The wick are equal on the both side. The open and the close are a little different from each other, like the open might be 100 rupees and the close might be 101, or the open might be 100 and the close can be 99. Okay, that way. So these 2 candlestick pattern defines indecisiveness of the market. That means the market is taking a pause there. It's not able to decide which side is stronger, whether it's the seller or the buyer. So you need to wait for the further confirmation before taking any trade. Okay, so if you're long in and up, the market shows a doji pattern, you should consider exiting at least half of your quantity. Similarly, if you're short in a downtrend and the market forms a spinning top or a doji, you should book half your profits immediately. So remember one thing, in trading nothing is fixed. Nothing works 100% all the time. So the only competitive advantage you as a trader have is your proper risk reward and the money management rules. So then only you will be able to make money in the long run. So now let's move on to the next section. You need to remember these 4 things. The candlestick pattern comes the first. The second is where it occurs in the chart, whether it occurs at the support and resistance or at the top of a uptrend or the down of a downtrend. The third is the follow through candles. You should always wait for the follow through candles and see whether the follow through candles crosses the lowest or the highest point of candlestick patterns. The fourth is you should keep an eye on the volumes whenever you spot any of the candlestick patterns, and use some indicator that should help you with determining whether the market is in a oversold or overbought territory. Here I am using the CPR indicator, which basically shows the support and resistance. Okay, so now if you see the support and resistance and try to correlate them with this patterns, you see how powerful it becomes. See, this is a hammer pattern. It happens exactly at the support region. You see how powerful this becomes, and the market rises very sharply after this. And you also see the volume is really good here, and the follow through candle is also good. So now here you see this, the market was a very strong uptrend, probably from here, and you see a shooting star pattern, or let's say the gravestone doji, you can say this. Now the volume is not great, but the follow through candle is good, and it happens exactly at the resistance point. Okay, and you can see that the RSI is also showing 64.76, which is in the overbought region. After that, you see how sharply the market fell. Actually, it fell really 0.72%. So if you take a short entry here, keeping the stop loss above the high of the shooting star, you probably get 1:10 risk reward trade here. Similarly, you see it's a very strong hammer pattern that happens after this fall. Okay, now the follow through candle is also there, but you cannot go long here because this is a resistance that is coming up here. Okay, till the market crosses this resistance, you cannot take this. You see this. Okay, so this is what I call as a very high probability trade. First thing is, it's a shooting star, clear cut shooting star pattern. okay, showing the bullishness of the market. The market was probably going up from here. Okay, you can see it's every, like, from 3 days it is going up consistently. It happens as a resistance zone. You can see that the RSI is showing 71, which is the market is in the overbought region. The follow through candle is also good. The follow through candle breaches the lowest of this shooting star. So here you can take a good short entry position, keeping the stop loss as the high of the shooting star and with a 1:1 risk reward. So guys, we have reached the end of this session. I want you to practice all the things that are explained in this video. So that's why you need to learn these things very clearly with a deep understanding that will help you really well in your trading career. We'll cover some other examples and also we'll learn the other candlestick patterns in the next video. If you have any queries, please post them in the comment section. I will try to cover them in the next video. So thank you guys. I hope you have found this video helpful. Please show your encouragement by sharing the video and pressing the like button. Thank you.